Ever wondered how a financial titan like Lehman Brothers could collapse overnight, sending massive shockwaves in the global economy, as what happened in 2007, 2008? A lot of people can easily say that the writing was on the wall, but despite all that, there's still a whole lot of people that lost their savings, lost their portfolios, wiped out completely. And even in the current scenarios, we have situations like that where traders go into a market and things happen, and therefore they are unable to avoid the risk that is presently affecting them and their investment portfolios in that particular market. In this video, we're going to talk about how to avoid financial disaster. And we're taking lessons specifically from the crash of the Lehman Brothers bank. What happened in 2008. If you still do not know what happened then, which led to the recession that the global economy faced, and then I'll leave the link to that script down there so that you can read for yourself and find out exactly what happened, and maybe you can get insights from that to avert such disasters, anticipate them whenever such a thing can occur in the market. Hi, I'm Kenneth, and this is Friday Money Matters. Thank you for tuning in. Don't forget to give the video a thumbs up and also subscribe in order to get fresh and exciting insights about the financial market, financial literacy, and all things concerning money right here on Friday Money Matters. The first thing that you need to avoid or you need to consider is you need to really understand the leverage risk. Now, leverage means that you're using someone else's money for you to do whatever you need to do. Now, according to Lehman Brothers, they used a leverage of about 40:1, which meant that for every dollar that they spent, they borrowed $40. So you see, it's a massive scale. The advantage to that is that it can amplify your profits. However, there's something that is hidden that a lot of traders always forget. The downside to that is that whenever you lose big. So not only does it amplify profits, it also magnifies losses, so that when you lose massively. So then the strategy will be to make sure that if your leverage is quite high, rather, in fact, why not avoid such a huge leverage? I know sometimes if you've got a smaller equity, leverage looks like the right thing to do. However, if you're to go to that extent, or maybe more than 40:1, maybe others are going as far as 200:1, always make sure that you've got very tight stop losses. The second thing that you need to do then is to monitor market sentiments. I've emphasized this on this channel, and I'll continue saying that trading is a technical exercise, no emotions involved. If you're going to go into trading emotionally, the chances of you losing will always increase. Now, I'm sure you've heard of something called revenge trading. Revenge trading is an aspect where after losing, you immediately go back into the market trying to recoup what you just lost. Now, the dangers to that is that because there are emotions invested in your actions, you are bound to lose perspective and not see exactly the whole scenario or the whole picture as far as what is contributing to the loss or what is contributed to the market to move against you, because your focus is just to regain what you lost or even to try and beat the market. This is a dangerous move. Do not put emotions in your trading. However, you also need to make sure that you monitor market sentiments. Now, the reason why a lot of people lost when the Lehman Brothers crashed is that they forgot that trading is mainly a game of speculation. Now, if there's a lot of speculation, you can then hedge your equity depending on what the market is speculating, what the market is expecting would be the trend or would happen. So you can measure that by looking at news, comments, analysts, and what the trend is. What is the noise out there concerning probably a particular asset, concerning the market in general? If needs be, then stay out of that market if you are not certain about the emotional state of the traders that are invested in that particular market. So always make sure that you measure the sentiments of a market concerning a particular asset, concerning a particular sector, or the market as a whole. Another key takeaway to learn from the fall of Lehman Brothers is diversification, and some more diversification is the key to this trading game. Now, for Lehman Brothers, their focus was mainly on risky mortgages. I'm sure you remember just mentioned that they had a 40-to-1 leverage, and because of that, then this amplified the risk that they faced in every endeavor that they made. So, therefore, without a diversified portfolio, it meant that if the mortgage sector or the mortgage bonds were to fall, it brought the whole house of Lehman Brothers down. Imagine if they had diversified into other sectors, into tech and so forth. It would have meant that whenever the real estate sector was crumbling, they could easily count on other sectors to try and recoup the losses that they were making in real estate. So please don't forget to diversify your trading portfolio. Another thing that you need to do is to stay informed about regulatory changes. Now, the financial sector always is faced with changes in regulations. There are laws, there are these bills that come in and change the entire financial landscape. So you need to be up to date on what is working, and what has been phased out. Now, knowing this will make sure that you are protected in case there is a certain stipulation or regulation that will go against you. Or alternatively, you can also make big gains if you really understood what the regulations were concerning certain asset classes, which means that you can reap the most benefit out of those because you really understood or understand what the regulations are. The next item to focus on is trend analysis. Now, there are so many tools that you can use on different platforms, such as moving averages, RSI. There's so many of them you really can count. The one that I like the most is the MACD, moving average convergence divergence. Now, it seems to be working well for me. I don't know if it does for you, but there are so many indicators that you can employ, and doing so will give you the right kind of insight concerning the market trends. Obviously, if you're looking at the market trend, try to look at longer term and shrink it into the time frame in which you're trading. A lot of traders go in and they look at the 15-minute chart or 5-minute chart, and the market seems to be going a certain way. But if you look at the larger time frame, you will see exactly what the trend could be. In the shorter frame, it could seem like it's a downtrend, yet it could just be a small reversal. However, on a longer time frame, you actually see the trend clearly. Take a day, take a month, and look at the entire system and the entire sector or the entire class. If you're trading Forex, look at the entire month, what the euro has been doing against the dollar. And then this will give you a more clear view for you to make the right kind of decision. The last thing, and this was supposed to be one of the first, is make sure that you employ strict risk management systems. Now, risk management is one thing that a lot of people overlook. You can easily pick the winning stocks or the winning trading pair as far as Forex are concerned, or even the winning crypto. However, because markets are often volatile, it is very significant for you to have very strict risk management strategies. Now, having a strict management strategies means that you have a stop loss. Now, this will be based on your risk to profit ratio, whatever the case might be. A lot of people always go for 2 to 1, others greater than that, others 1 to 1. But how much are you willing to lose per trade for you to get out of that trade? So it means that you decide beforehand, before you actually make the trade, this is how much you're willing to lose in case the market was to go against you. This way you are able to minimize your losses so that you are not totally wiped out. Many traders find themselves totally wiped out because they did not put a stop loss. Try a trailing stop loss. It will work wonders for you. These and many more strategies can help you as a trader to avoid the risks of loss as what happened in 2008. Now, learning from your past mistakes is one of the most important traits of learning. In trading, you are bound to make mistakes. Please ensure that you learn from your previous mistakes, especially where you made a loss. Always go back and find out exactly why it happened before you can make another trade. This will minimize the amount of losses that you make. Please don't forget to give us a thumbs up. Always share to other traders and also subscribe if you have not yet subscribed. This is Friday Money Matters. We'll see you in the next video. Bye.